Hello, everyone, and welcome to the Psychology of Investing. I'm Holly Madasser, and I'm joined here today by our esteemed panelists, Michael Velez and Drew Knust, both from Franklin Templeton. Thank you for joining us, gentlemen. We also have with us our very own Teresa Talton and Lindsay Brock, both wealth advisors at Stearns Financial and both certified financial planners. So obviously we decided to host this special event for a variety of reasons, not the least of which is the fact that stocks and bonds are both down. We have high inflation, we have negative GDP, we have low consumer confidence, and we basically have scared and skittish investors. So I know that we at Stearns have been fielding a lot of questions from clients asking us, what are you going to do? Our portfolios are down and bonds are even down. What are you going to do? So I'm first going to suggest that we've done it. We have good diversified asset allocation, and we've been counseling our clients for a long time to have money on the sidelines for exactly this purpose. Still, as investors, we're used to stock market volatility, but we're not really used to seeing bonds decline at the same time. In fact, I think that's only happened maybe 3 times in the last 50 years. So Drew, if you would take a minute, please describe to us a little bit about Franklin Templeton, and then tell us what you think is going on in the economy today.
Sure. Thanks, Holly. So happy to be here. Thank you, everybody, for tuning in. Very briefly, I'm a private wealth director at Franklin Templeton. I work with asset managers and RIAs like Stearns on thought leadership, product solutions, insights on the market to help them and also investors. Franklin Templeton is a firm you may have heard of. We've been around for 80 years. We've got $1.5 trillion under management across mutual funds, ETFs, separately managed accounts, and alternatives. In fact, we're the 5th largest provider of alternatives in the industry at over $270 billion, the 3rd largest provider of separately managed accounts in the industry, and a leader in thought leadership across the investment management world. As we jump into the environment, as we can all see, today is no exception. It's been a really tough year. I mean, if I look at the markets, the S&P is down 20, the NASDAQ, which is our tech index, is down 28, the international index is down 18, and then as Holly alluded to, bonds, which are usually our safe haven, are down almost 11% as well. And there's a whole lot of noise in the marketplace today, but kind of 3 things that I think are driving that we'll probably address in more detail throughout the call. One is inflation coming out of COVID has been much, much greater than anybody expected and has gotten, caught the Fed off guard to some degree. And so if you're looking to buy a car, I'm lucky enough, I've got 3 kids at home. I'm in the market for a minivan, and I got quoted $60,000 for a Toyota Sienna, which in my opinion, $60,000 is a lot for a very uncool car. Food is very expensive. Housing has gone through the roof and maybe showing some signs of slowing with mortgage rates increasing, but that's number 1 is inflation. 2 has been the Fed's response to inflation. And this is where, fixed income has really suffered as the Fed has stepped in and in order to get ahead of inflation, started to raise rates pretty aggressively. And when rates rise, bond prices fall. And in this environment, your safety net, as rates have gone, almost doubled, the 10 years doubled from 1.5% to 3% just this year, bond prices have certainly been impacted. And that's number 2. And I think 3, and there's a number of different things in bullet point 3, we've got a lot going on here in the United States and geopolitically. We've got the war in Ukraine that really nobody expected, that has caused a lot of uncertainty and market volatility. We've got an election year. And I'm sure Mike and Holly will touch on this, but during an election year, we typically have larger than normal drawdowns anyway, because there's more uncertainty in the world in front of us. So in light of all that, there are some places that have been doing actually pretty well this year. And I know that Stearns does have allocations there. Commercial real estate has continued to hold up very well and pay consistent income. Some of those strategies are up, depending on the index, 5 to 10%. Private debt has done very well diversifying clients' portfolios. Commodities, not fun to fill up your tank, but from an allocation standpoint, done a really good job of hedging you against that as well in an environment like this. So there are some things to be positive about in light of what is somewhat of an uncertain market. And as I pass off to Holly, I think the overall message of the presentation today is this has happened before. and this will probably not be the last time it happens. It will happen again. And you really need to take a step back and look at the market in perspective over a long term versus just in a 6-month period like we've seen so far. So with that, Holly, thank you so much. I'll pass it back to you.
Thank you, Drew. By the way, your reference to a Toyota as a very uncool car was neither an endorsement of or against Toyota as a stock, right?
Right.
Thank you so much. So obviously, this all sounds good in theory, but it's hard if you're a retiree, as many of our clients are, and you're holding stocks and bonds. Unfortunately, we do have alternative assets, and that is the only asset class this year that's in the positive. So that's a good thing. But it's hard for our investors to stay the course. And of course, the anxiety creates a self-fulfilling prophecy, right? Because the more investors exit the market, the lower the market goes. And so it's not only bad personally, but it's bad for the markets as a whole. I know as an advisor, I've had to counsel, and I'm sure Lindsay and Teresa have too, several of our clients not to panic and just stay the course. So Michael, I know that your specialty is behavioral finance, and one of the things that you focus on is the impact of that on markets. Right. Can you educate us a little bit about investor behavior during market downturns and what the impact of staying in or exiting the market might be?
Yes, of course, and thank you for the opportunity to. I'm just going to go ahead and share with you some data here, really on some of the psychological fundamentals that we see during market episodes as we are. Really what I'd like to do is emphasize, for the most part, that this is within the cycle of normality. And I'm sure you've heard this before. Bull markets tend to have greater strength and last for longer. And generally speaking, the average over the last 25 years or so has been 7 years for bull markets. Bear markets do come as well, usually lasting only about 13 months or so, with an average fall of 41.7%. Now, I want to just reinforce this idea here so everybody understands just how unusual it is, the circumstances that we're currently facing this week. We've just endured 2 bear markets, essentially in the last 2 years since COVID. And just to give you a sense of comparison here, I have here a chart outlining essentially the level of a market correction, creating downside volatility comparatively with how normal it should be. A 5% correction is generally observed every 9 months or so. This is a normal correction, very healthy economic situation here. Nothing, it's just really the checks and balances of the free market system. 10% is also fairly normal, occurring once every 2 years, and a 15% correction is what we see generally every 4 years. Now, a 20% or more correction is fairly rare, occurring every 8 years. The last 20% reduction we've had was just about 8 trading cycles ago. And so this is following, the previous one was in March of 2020, just after COVID. So within a 2-year period, we've had 2 of these very, very rare, but within the context of normality, economic episodes that should have taken place every 8 years within 2 years. Okay, so that's the extent of sort of the volatility and the uncertainty that we can see here in this chart. If we look back for the last 50 years, this chart assumes a $10,000 investment all the way through the energy crisis of the 1970s, Black Monday, which was a very significant retracement in the 1980s, the tech bubble in the early 2000s, the global financial crisis, and then COVID-19. I'm just going to use my laser pointer here to show you some of these lows here. That was that first bear market that we saw that shook the markets. It was 4 days in March of 2020, and this is the one we're just recovering from here. And if you look at the intermediary period there, you see that these, equities, were extremely volatile to the upside, but we're working with a situation that is somewhat uncommon, and that bonds continue to suffer. That is largely due, unfortunately, to what COVID-19 brought into the world in terms of uncertainty. The need for immediate stimulus, for the most part, for persons who are not necessarily associated with asset management in general for their income, was so great, and the uncertainty so great that we have essentially over-infused our economy to compensate. And now, given the fact that we've had 2 of these very, very rare episodes, the market seems to be reacting in a very, very sort of trepidatious optimism to date. We've introduced some procedures to sort of swell the inflationary issue. They've just begun. But of course, we're starting to see a little bit of that tepid optimism because of the amount of uncertainty that we've gone through already. So the damage having been done, it's now starting to look like we've entered into the beginning of the recovery period. But of course, as there's so much trepidation out there, it could be very easy to fall into the trap essentially of selling at the worst possible moment. Staying fully invested at this particular time, as difficult as it is to maybe swallow. And my own mother very recently had a phone call with me of a similar ilk, wanting to sell some of her positions. She's a retiree herself. And I said, Mom, if we can just endure it, really the competition right now, the contest is one of endurance. We've gone through the damaging element already. And barring an emergency use for those funds, my recommendation to my own mother was that we should stay invested. As a matter of fact, as difficult it is as it may be to hear, the conditions that we are seeing are suggestive that perhaps to go further into some investments might be the best opportunity if we can afford to do so. And so just want to show you here one last graphic here. If we stay fully invested through a 20-year period, an annualized return is yielded of 9.19%. Now, I'm going to use an analogy here to World War II. In World War II, many of the fighter pilots that scored enemy kills in combat were actually, the kills were actually very much concentrated within a small group of pilots. In other words, a small group of pilots did most of the combat, and the other pilots generally would have one or two or something like that. The market behaves in a similar manner. We see most of the market growth. In other words, the most opportune days are few. They come in small tranches. The only real way to take advantage of those single days in which the market outperforms is to be invested in preparation for it. If one was to miss the best 10 days of that same 20-year period, their return would be reduced to 5.68. That's how important being invested for those increments in which we see that large scale alpha growth is. And if they miss the best 20 days, it reduces further to 2.96. And if the 30 days, the best 30 days alone were removed from that 20-year period, and all the other days they were invested at the same increment, they would yield almost nothing, 0.09%. And of course, this just obviates the understanding that we have that in order to really be prepared to heal, one must put themselves in that position to accept healing. And that is essentially what the market can return from us. It's so difficult. I know we've gone through this very uncertain time, probably the most uncertain time. I was referring yesterday to this with my colleague, Drew. In my tenure as a professional in the finance industry, this is the most uncertain time. However, again, signs are starting to appear that would suggest that we're just about to come out of it.
So, Michael, if I could interrupt for a minute, can you go back to that slide? I don't know. Yeah, there you go. So I have some clients who have said things to me like, why don't we exit the market right now? And when we see things start to turn around, we'll go back in. And my understanding is when things start to turn around, it's a very quick window. We don't know when it's going to happen. And we see the most growth immediately at that point. So yeah. It's what you're saying here is if you even miss the top 10 trading days, you're reducing your returns by over 3%.
Yes,
over a 20-year period annualized, right?
Yes, generally speaking, what we're trying to do is be ahead of the market. It's very, very difficult. It's not totally impossible, but it's somewhat out of the bounds of a fiduciary responsibility. It's somewhat brazen to try to chase the gains after they've occurred. What we typically see is that there's an immediate shift in the market at 3 or 4 in the morning when, no real markets are operating at the particular time. And then by the time the market opens and there's further access, in other words, if we're quick on our feet to react, we still have to wait a window of this intermediary period in which the market's already been set. Movements generally happen when we are not necessarily exposed to them happening. This is why we have to work in perpetuity in front of the market. It's very, very, very difficult to take gains, it's sort of in a counteractive motion. And so I think that, for the most part, the calls that I've been fielding lately, and those of my colleagues as well, have been of a similar ilk. Our main concern, again, speaking as a fiduciary, at this particular point, my primary focus is to recover as much as I can in fiscal damages that have been incurred to date. Because again, the real story here is that we have gone through the trauma. Okay, we already started the process of implementing programs to stop the bleeding thereafter, but we have to now make our way through the surgery, if you would, to use a metaphor. We are in the healing process. It's just begun. And so really what we're trying to do is avoid underexposure, because of course, as fiduciaries, it's not just our responsibility to avoid a market crash, or it's also our responsibility to make sure that our clients are in the position that they need to be to best exploit the volume that we know is coming based on the science of our economic studies. And so right now, my primary concern is positioning clients in a position so that they can reap the rewards of the coming healing process. It could be a difficult situation to be in, but all signs indicate that we've gone through the worst of the woods so far. There may be a little bit ahead of us, but there's light.
Well, we look forward to hearing the good news in just a minute, but I'll let you continue with your slide presentation.
Sure, certainly. So is it still up on your screens, or did I stop sharing?
Yeah.
And so here we have just an example of one of the benefits of staying in the market despite going through losses. So if we can just stomach the fact that some of the valuations, for example, on the equity side, in tandem with valuations in the bond side, both losing value over time, have been incurred, and we are in a position now to exploit the rebound upwards, we can, of course, essentially do our own self-compounding by purchasing additional positions at a much lower cost, thus averaging against our original cost, high as it may be, will reduce the overall cost, and actually we can actually gain more exposure to what we would want to gain exposure to in the coming days going forward at a far, far discounted price. The only issue, of course, is that it is somewhat distasteful to our own psyche to do so, because this same, these positions have to date, of course, only hurt us. But if we realize that the situation was so uncommon, it's not necessarily that fiduciaries were putting us in positions that were against our best interest. It's that the situation shifted so quickly that our best interest was undermined below us. It was not something that we could have seen coming. Certainly, COVID-19 was somewhat unprecedented in the modern era, and so forth. And so dollar cost averaging, to an extent, allows us to pick up and gain ground that we have lost at a discount if we're able to do so. But we have to go against some of our inclinations, like fear and trepidation, that can come from a long period of uncertainty that we've had to date. So again, this is going to be something that we have to sort of analyze within ourselves to see how much we're willing to go forward with this, if the risk is warranted, and so forth. But the discount is there with the dollar cost averaging system. And so if we just for a moment try to discipline ourselves here, this is a chart from the S&P index from the last 50 years as well. If we're checking in essentially on our gains and losses every single day, if we were to do this every day, we would see about 54% gains. Okay, so that's just a little higher than average. Every other day we might see a gain. If we looked at it monthly, though, 63% of the time we would see a gain. If we only looked at our portfolio once per year in the last 50 years, 80% of the time we would see green. 3-year period, it goes to 86, 5-year period, 90, 10-year period, 91. Now, of course, not every person can afford a 10-year window. We understand that. But my point in showing my audience this today is that the frequency for which we check in the market oftentimes leads to a higher frequency of disappointment, because the market itself functions on a very, very macro and strategic level. What I mean to say is that it moves over long courses, over the course of many, many years. But if we are pre-positioned to take advantage of those movements, it works to our benefit. It's not necessarily so beneficial to be constantly looking to see where daily gains are. Yes, there is a field within our industry that does that. It's called frequency trading, and it requires quite a bit more skills and a lot of focus. And it's not necessarily really the best yielding field either. It really is, generally speaking, to stay the course over the long haul will prove the best material strategy. It just, again, happens that we are in a very, very uncommon time. Now, let me just show you just how uncommon we are in. So these are all of the market retracements. In other words, the highest point that the market has been in valuations, followed by the lowest point thereafter. High to low is all we're looking for here. And if you recall, I mentioned that a 20% retracement or lower is called a bear market. There are only a few of those. Here's one here. Here's one here. This was the global financial crisis, and this one was COVID. So we have these sort of black swan events. Aside from those two, in the middle is generally where we see the market rebound. Okay, and so after COVID, a 34% bounce, we went back up to 27% positive. This is essentially the window of opportunity that is going to expand one's yield that we're waiting for. And when I go back to what I said earlier, that most of my colleagues at the moment fielding calls from trepidatious clients are actually trying to calm the nerves to the point that we can illuminate that the most important position to be in at this moment, given the fact that the damage is already done, is a position to gain from what is to come. Now, the good days, as we mentioned, what is to come, largely at the moment dependent upon a strategy of curtailing how much currency is in is in circulation right now. We do this by raising interest rates. Now, our Fed has introduced an interest rate hike of 0.75 pips, or 3/4 of a percentage point, which is a fairly moderate to strong increase. But what has created the problem that we're seeing in bonds, and what has been so unique to this, because generally speaking, we can seek refuge in bonds. What has created this issue now, where refuge is not yet found in bonds, is because the bond traders themselves are actually waiting to purchase large-scale bonds at a higher yield. And the reason that we know that a higher yield is coming is because, very unprecedented situation, because of COVID, it was considered more reasonable to advise the market as a whole from our US central bank, the US Fed. And this is very, very unusual, because when they do that, of course, when an inference is made that further gains to the interest rates will come, as a bond manager, as a bond purchaser on behalf of my client, it's better for me to hold back and to wait for those bonds to pay a higher yield. Wouldn't you prefer to have a 7% yield on your bonds, and if your neighbor had 8%, you'd want to have that 8% as well? And so bond traders, for the most part, are holding back because we know that the bleeding has begun to stop. We have great news coming from Germany to suggest that their inflation rate has held. And so Germany is a good bellwether, because the German economy was already predisposed to some of the higher social spending that we introduced. What I mean to say by that was, when Germany started to spend a little to help combat COVID, their social spending was already included in their economy. And so the differential was not so great. Here in the United States, we spent about 15 years worth of social expenditure in 2-year period, actually an 18-month period. And so we had to go above and beyond what our economy is generally capable of sustaining. However, still objectively good news coming out of Germany. We do see that their interest rates have paused, which suggests, at least to most of my colleagues and myself as well, share in this opinion, and that the bleeding has begun to stop, and that we are starting the process of healing. Now, as soon as those yields rise, it will constrict the money flow further, and it will allow bond traders to release a lot of that money that they've been waiting to spend on behalf of their clients at a higher yield. And that should start to really balance out, and also bring great yield to existing bondholders and balance the markets out. Of course, we have to wait for that period. A natural question to ask, of course, and one that I field all the time, is, Mike, why didn't the Fed just raise the interest rates 2 basis points, or however long it should have been? They've said they've raised it 75 bips, and they said an additional 75 bips, and even another half of 50 bips is behind that. So a potential 1.25% in the future. Why didn't they just do that immediately? And the reason for that is because it would so constrict immediately, it would so create a higher cost of currency, that our current deals, particularly on the small business side, small business loans would probably be the most, to benefit from the lower rates. They would constrict, and we would essentially stop the economy too soon, disallowing capital to flow in the economy at that level that quickly would really do harm. So we have to ease it in. We have to have essentially persons who are in a position to make use of capital get used to the idea that it will be expensive. And generally what we do see is actually a rush of new loans in an environment like this, and we have. So actually, the interest rates rising will create new productivity in the small term, and hopefully that will offset. But I get a little too technical there. Just wanted to give you some clarity onto the potential process of healing and the road forward.
So I heard, and it's wonderful having an economist on with us, and the obvious question, I guess we can take the slides off if you'd like, Michael. But the obvious question for our investors and consumers is, when is the pain going to stop? So it's painful for people right now. High gas prices, high inflation, and even the geopolitical events just creating a negative state of anxiety. And you know, we're talking about taming our psychology, but it's hard given the news. So I'm hopeful that you can give us some good news, because I heard an inkling this morning that GDP for Q2 might also be negative. I don't know if your sources are confirming that, but that would be an actual recession, right?
Yes, and you know, I would caution against being the word recession is not necessarily as impactful as what we see in a large scale recession. The United States is a very, generally speaking, a high level of productivity, and perhaps a recessionette, as I like to call it, a small scale recession, won't necessarily be that damaging. Now, we are expecting a moderate decrease in productivity as a result of a lower GDP in the next quarter. I don't think that is necessarily at cause to harm. Now, the good news here, let's imagine that everything goes well. We could see something in the range of 18 months where essentially the bleeding will stop and markets will come back. If it does not go well, all things considered, Murphy's Law, we start to see a larger than expected unemployment number, and those things, and it could be as much as double that. So between 1 year and 3 years is probably the best window that we can say as sort of an opinion of the community. However, I think that there's actually quite a bit to salvage here. Our employment numbers going up, GDP through the pandemic was quite strong. It's going to leave us in a position, I think, that of economic strength. I do not foresee that the United States productivity overall is going to be a negative factor going forward. Perhaps we will endure a short recession, as I mentioned. I think that it's more than likely that if it has occurred, has already started to occur. I don't necessarily see it getting too far worse. I think unemployment numbers will remain high. There will be some unemployment gain, of course, loss of employment to a certain extent, but I don't think it's going to essentially put us out. I am firm, and I think that I speak for the plurality of my colleagues here, that we've gone through such an uncharted water period, such a period of just uncommon challenge, that the markets have started to readjust. And actually, I think that the deflation of value in Bitcoin is actually a positive for the market. We're starting to see all of the distractionary vehicles that emerged start to deflate, and people coming back to their senses on a global level. This is good. The fewer the fewer distractions that there are in the economy, the better we can get back to what we can measure and what we can process to be strong and what is not strong, and we can start to balance out the need of supply and demand in the economy further. I really am of the opinion that the beginning of the end has started. Now, again, whether that end is a 12-month end or whether that end is a 36-month end is going to really come down to the nitty-gritty over the next few cycles. It does not suggest to me, even the word recession popping up, does not suggest to me that there's going to be a traumatic loss of valuations going forward on either the debt or the equity, or the debt or the equity side.
Well, that certainly is encouraging, although 3 years feels like a long time. And especially if we're telling our clients and investors to stay the course, I'd love to shift our attention, if we could, to what they can do. So if the message here is that we're not going to shift our portfolios, we're going to not exit the market, we've got to stay the course and just tame our psychology, I'd love to be able to invoke our financial planning team in terms of what can people do. And before I do that, Michael, you mentioned Bitcoin and NFTs in general. There was some frivolous activity going on. Again, that was not an endorsement or anything related to Bitcoin. So I just want to make that clear for our audience and for compliance reasons.
Of course.
So Teresa, if we could switch to you for a moment, tell us what some of the concerns that you're hearing, again, mostly retired clients. What are you hearing from our clients, and what is it that you can recommend that they can do? So they can't go into their portfolio and start selling, because that's a mistake, but what can they do?
Yeah, so first we just want to recognize with them it's natural to be concerned. We just this is a scary time. People have built up their livelihoods and depend on this money. And so we know that it's scary. We just don't want their fear to lead to them doing things like selling an opportune time and locking in those losses. I want to just mention that when clients log in and look at their accounts and their accounts are down, that's an unrealized loss. That's just a paper loss. If we stay the course, based on the information Michael just shared, historically, bear markets return or recover within 13 months. If we lock in the loss and we sell it, then we realize the loss. So yes, we can't control any of the economy, what's going on with Ukraine and interest rates. So let's, I'll just shift over to some things that how we can control our own economy. So one thing which might seem kind of obvious is to maybe delay or downsize some large ticket purchases. So maybe if there's a home renovation that's on the table, a kitchen or an add-on, perhaps think about either downsizing it, scaling it back, or just pushing it off, which may happen naturally because it's really hard to find contractors these days.
And so it's also hard to find appliances. As I know myself, looking for an oven, it's 12 to 18 months.
Right. Right. So this is, by the time we're able to get any of these things in stock, perhaps the markets will have recovered. But travel is the same thing. If there's a big trip that you've been planning on taking or a car purchase that you're considering, perhaps push that off for a little bit if it's something that you would need to normally pull assets from your portfolio, pull money out of your portfolio in order to fund. As far as emergency reserves, we always love our clients to have emergency reserves on hand. That the amount depends on someone who's working versus someone who's retired. Large range could be 3 months, anywhere up to 2 years. So, but we want you to keep that on hand. That's really important to make sure, especially for retirees, that they can fund their living expenses with that and not need it to necessarily, not pull from their assets in order to just fund their lifestyle. That's what the emergency reserves are for. Go there first. However, because so many people have been sitting at home and not spending, especially retirees who may have pensions and Social Security coming in regularly, so they've built up more cash than maybe what they intended in emergency reserves. It's a great time to take extra cash above and beyond your emergency reserves and consider investing it in the market, which Michael mentioned, because you're buying low at this point. It's on sale. You can think of the market as it being on sale. And Holly likes to say it's the one place that people love to run from when things are actually on sale. So this is a great opportunity for people maybe who have sold a business and have a large windfall from a business, or maybe a second home sale, or even primary if they're not planning on purchasing another home. This is a great time for them to maybe dollar cost average into the market. And then if you're considering retirement, it's probably a great time to revisit your financial plan, or if you haven't done a financial plan with us before, it would be recommended to do that and make sure that everything is copacetic, that you can retire and live the lifestyle that you want. And for some people who maybe are getting the early retirement packages, there may be a severance package that is included that could be your living expenses for the next 6 months to a year. So there are ways to retire earlier than maybe expected, and we can look at all of those facets within the context of a financial plan. So definitely contact your advisor if you're considering it before you even pull that trigger.
And Teresa, I do want to add a few things there. The financial plan that we do for a lot of our clients, actually most of our clients, that typically includes a Monte Carlo analysis, which, excuse me, I'm not a gambler, so I don't know the relation there, but at least in our context, what it does is it randomizes historical events, specifically in the stock market. So it is already looking at what could be historically poor times for your portfolio, and it's looking at what are the chances that your spending will make it with a percentage of success. So revisit the Monte Carlo with your advisor. And on that note, I also just want to add that those individuals who use financial advisors are typically research shows that you're going to see about 1 to 2% of added return on your portfolio, specifically attributed to working with your advisor through behavioral coaching. So not even considering all of the tactical adjustments that we do or Drew or any of our teammates here, but specifically just talking to somebody about your portfolio and your concerns could help you stay in the market, really.
That's a great point. Thank you.
And I also want to clarify for our audience, we have coached most of our clients to have money on the sidelines, 1 to 3 years of cash. We're not suggesting, I don't think, Teresa, that they start withdrawing from that right now. If you're used to getting your paycheck from Stearns into your account, that is continuing. We have reserves within the portfolio to do that, but we will let you know when it's time to tap into those emergency funds.
Yeah, thank you for clarifying.
Yeah, I mean, but the big ticket items, you're absolutely right. So Lindsay, I'd love to turn to you if I could. I know that you work with various generations of clients and friends, and just wondering what advice you might give to people in different various ages and stages of life, given current market conditions. What can they do, for example, if you're a few years into retirement versus if you're a young investor?
Yeah, Holly, that's a great question. And a lot of our conversations with our clients turn back to time horizon, right? So if you're in accumulation or spending mode, that's going to form a lot of the conversation you're going to have with your advisor and your outlook for your next 20, 30, 50 years. So you're right. Somebody who's a few years into retirement and concerned if this is going to change their financial plan, talk to your advisor, see that they have maybe run those Monte Carlo analyses I mentioned before, see if we've run some down market estimates, or even some extra spending that you might have not anticipated for extra medical costs or something that might crop up in the next few years that you hadn't expected. So, but otherwise, I think staying the course definitely is the most paramount for that group of people. Looking at the new retiree, unfortunately, that is probably one of the most scary times to be in your life process during this time. And the same thing in 2008, the same thing in 2001. But if you happen to choose retirement in a year where your portfolio is down, it's probably going to affect your withdrawal pattern. And so just, again, talk to your advisor, and that's where you're going to lean on those cash reserves, and we'll advise you when to start pulling from there. But again, staying the course. Whereas if I'm counseling younger clients, those who are maybe a young family in accumulation mode or a young professional, it might be more, I think, as we've all mentioned, leaning in and finding opportunities at this time. So if you're still earning a paycheck, if you're still, you have job security, and you know that you'll continue to work, even if you are part of a recessionary layoff, you still will be gainfully employed for some years. This is the time that you can continue to save, maybe even a little bit more aggressively, and take the chance to buy low, or buy as low as you can. And the one piece of advice I would have for those younger clients is more just on risk and protection. Just make sure that your family is feeling solvent with job security, and that you are protecting you from the risks that you have. Whereas your portfolio, if meant for retirement, is really going to be able to recover over the next 20, 30, 40 years. The last piece I do want to talk about is for our youngest investors who maybe were looking to buy a house in the next few years. And this is a really tough position to be in, but it's one that hopefully we've counseled you that those monies that you were expecting to use in the next 1, 2, 3 years, hopefully we're not too exposed to the stock market or even too much to the bond market to feel those lows that we're hitting right now. And hopefully you were struggling with low interest rates over the last few years. Now, with the Fed raising interest rates, you hopefully should be able to continue to plow into those savings and earn a little bit more in interest that can go towards that house purchase. And we'll just keep waiting for the housing market to cool off and for mortgage rates to stop rising.
Well, and actually, we're seeing a lot of evidence already of cooling real estate. I know just anecdotally, in our case here in the Triangle, we had clients who would sell their homes at the top of the market, sight unseen, full cash offer, above and beyond cash offer. So with bidding wars. And most recently, I had a client at the beach put a property on the market. She only got one bid on it. It was below asking, and it was fully leveraged. So we're definitely starting to see that the tide is shifting. And Michael, you might want to add some to that. But I think even though interest rates are higher, mortgage interest rates, I think we're going to start to see a bit of a leveling off of housing prices in general.
Yeah, I believe so. My personal prediction, as I mentioned earlier, is I thought it was about a 7% decline, but it would probably be a slower decline on the retail side, sort of like a parachute coming down. The demand is just so very, very high. The real estate market, definitely saw, huge gains throughout COVID. It has put itself in sort of a distant position with respect to everything else, and certainly how much power it has over the overall economy. But I think that what we're going to see is a light decline over the course of the time. Don't necessarily see the same thing in commercial, but we're not seeing any of the signs of sort of like a drastic shift that we've seen in previous market cycles like this. So it seems to be one of the more sturdier areas, but again, due for a healthy decline, I think, of around 7% total nominal.
And I'm sure it depends on what part of the country you live in.
Yeah,
So
that'd be a national.
Yeah. We have a question from our audience, and it is, in today's environment, Michael, where would you invest money to take advantage of this, of the state of things currently?
All right. Well, that's a good question. If my concern is purely yield, we see the exact opposite. Taking money away from what is ethereal and not necessarily proven, like digital assets and things like that. Small caps certainly have seen a shortage. We don't necessarily want to chase speculation at the moment. If we can afford to include some commodities exposure, particularly hard metals and in-demand strategic resources, not necessarily something that we go to all the time, but maybe in the asset allocation question, a little bit of exposure to commodities purely for the yield. Now, again, of course, with that yield, you have something of a liquidity issue. You may not necessarily be extricate yourself. My personal persuasion, what I would tell my own mother as recently as last week, is that there's a lot of valuation in stocks and equities at the moment. If we can afford to perhaps go into some of the higher dividend equities or something, Warren Buffett is finding a little bit of refuge in Apple, but of course his position is so large in that position. Bonds are going to be a very, very strong component fairly soon. It's going to come down to the next Fed meeting when we see a more than likely what has been inferred as another 0.75 basis point increase. With that increase, though, it's not going to be a surety that we'll see a third. And so if we can do enough stopping of the bleeding with the initial one, we may only have these two. And if that's the case, we're going to see quite a bit of happy days for bondholders and new bond purchasers as well. And that's starting to see a little more likely from what of the data we're coming out of Europe. Still in the woods, as I mentioned earlier, but it's getting more clear. I would put some money aside for equities at the moment, particularly with good PE ratios and some dividends, if we can afford that, and start cultivating a position for bonds in the next cycle or two.
That's excellent advice, and you're forcing me to disclaim again, Michael, with stop that.
No position whatsoever, of course. Standard disclaimer, no position, and I don't intend to make one.
Okay, well, I think we're just about out of time, but I just want to, I believe that the overall message here to our audience, and I hope it helps, because we do understand that these are stressful times. Please reach out to your advisor if you're having trouble sleeping at night, if you're having difficulty with the market volatility. Reach out, don't do anything rash. And basically, the name of the game right now is to just stay the course. It's virtually impossible to try to time the market, as Michael's slide showed. If you're out, I think it was 30 days, right, Michael? You basically make nothing, and I don't even know if that was inflation adjusted, so you might actually be losing money, right?
Correct.
Yeah, so you'd be losing like 3% just by being out the best 30 days. So it's just not a good strategy. Our goal right now is to tame our psychology and not lock in these losses. The damage has been done. And so what we want to do now is capture as much of the upside as possible, whenever that is. Hopefully 12 to 36 months. I'm hoping for the 12, but who knows, right? In any case, thank you all for joining us today. Please be in touch with any thoughts or questions. And thank you, panelists. You've been great.